This is the macro show. This is pregame, okay? We're trying to play the game that's in front of us today. You know, leadership matters at Hedgeye. So again, being transparent, accountable, and trustworthy people. This is a game about playing and weighing probability. It's not about picking stocks. It's about picking the right portfolio.
2 questions on this. So I'm going to ask, it's a little more of a process question. This JD Pauly asked, and then this is from Dougie Cass, who says, keep fighting the good fight. I continue to admire Hedgeye's unemotional process and the consistency of logic and strategy. The question is, do you weight your independent variables that contribute to the calculus of risk ranges? And JD Pauly had asked, with price, volume, and volatility, you know, how do you think about volume and all that? I think if I understand correctly, it's dynamic, right?
Like it's dynamically reweighting for marginal impact is what we call. So all of our models are built that way. A certain someone says, oh, everybody knows how to do that. Bullshit. He definitely wouldn't have known how to do that until I sent him to the Khan Academy. And then we started talking about the real math. But the fact of the matter is that that's a fact, okay? That there are three variables. Let's just do this quickly because I've done it before. I think you guys can find this on Hedgeye University, where that was pretty cool. Big red stripe there. So we have, let's just do it quickly. So if you have a 3-factor model, price, volume, and volatility, then when I say it's dynamically reweighting for marginal impact, okay, what does that mean? So marginally yesterday, let's just use basic examples, volume was plus 9%, but volatility was up a lot more than that. I don't think of volatility in percentage terms, I just think about point to point where it went. So it went from, essentially in less than 5 trading days, it went from 18 to 23, right? So it was the vol that really moved, but it did have this component up, and this really gave you the down 2% day on SPYs, right? That's the setup for a down day, where the relationship between price down, volume up, and an explosion in volatility, that is easily the biggest marginal impact in the model that says, whoa. And then you wake up this morning, you get a big lower high in the range for the first time, and that's a function of that relationship. Now, if you had this go differently, let's say that so we got, I just don't want to mess up the colors here. Price, volume, and volatility. We're using, I was using VIX as an example. So these are 2 V's. One is volume, one is volatility. So let's say that we had VIX didn't do anything. It just kind of like, it went to nothing burger. It went to 19, volume was down, and price was down a little bit. That's not the same thing. Volume accelerated, an explosion in volatility, price down hard. Okay, that is the bear. That is not the bears around the campground because it's quad 4. He's in the tent and he's hungry. Okay, and we've talked about bears. Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.